Since the financial crash of 2008, there have been 5 stock market corrections, the longest lasting 157 days in 2011. Experience teaches us that market corrections, even crashes, are expected in the long term. While a correction typically represents a decline greater than 10% but lower than 20%, a crash can be unpredictable and much larger. Here are some factors that can help you spot market crash or correction. For example, understanding financial statements. You don't have to be an analyst digging through multiple financial statements to understand the health of the economy or overall market. Instead, you have to be familiar with key indicators such as P/E ratio and profit margin. Indexes are a great way to get an overall sense of how market is performing since they track the performance of the group of the companies. Let's take the S&P 500 for example. Preceding last two market crashes of 2007 and 2020, the S&P 500 forward P/E ratio was an all-time high and then dropped along with the price of most stocks. In the same way, profit margins of S&P 500 peaked before the last three recessions of 01, 08, and 20. Although they are not an immediate or 100% accurate indicators of a crash or recession, these two financial indicators are the ones to watch if you suspect a market crash or correction. The technicals. Over the last few years, the province of technical trading, especially momentum trading, has grown as software innovation. Among the hundreds of indicators out there, experienced investors typically watch these two: Relative Strength Index, RSI, and Moving Averages, MA. And it's pretty easy to use them. Simply overlaying a standard index or a stock market with these indicators will help you spot red zones, a price level that may predict a market correction. Relative Strength Index uses the price changes to determine whether a stock is overvalued above 70 or undervalued below 30. While a neutral level between 30 and 70 can provide a sense of safety, it is important to see if the trend is moving towards overbought or oversold territory. According to mean reversion theory, prices often return to their long-term averages. So, an overbought or an oversold investment experiencing a correction may return to a lower price or a higher price respectively. Moving averages display an investment's average price over the specific time period. The 50 and 200 days simple moving average help technical traders identify patterns, such as death cross, a sign indicating a potential sell-off. A death cross occurs when an investment's 50-day average falls below 200-day average, and it's often followed by the drop in the price caused by the sell-off. Other economic indicators. Regarding to the views, economists will agree that economy is subject to a cycle. That means we go through the period of growth, peak growth, recessions, the bottom of the recession, and repeat. Economic indicators can help you track where we are in the cycle and potential signal when we are near the top. There are three categories. Leading indicators, such as number of permits builders are applying for and the money supplying the areas. These may provide insights into where the economy is heading. Lagging indicators, such as inflation or unemployment rate, well, those only help us confirm our beliefs, and they do not hold any predictive power. Lastly, we have coincident indicators, such as GDP and personal income numbers. They provide current snapshot of what's happening. Using them all together may help you to get a clearer picture of where the economy is headed. For example, rising inflation coupled with low rates of housing starts, that is leading indicator, and lower income numbers could be a sign of a looming recession or market crash. If you're new to investing, consider outlining your investment policy on a sheet of paper or in a Google document. Documents like this usually prepared by advisors summarizing a tailored strategy for a specific person. This is a great way to keep track of your investment guidelines and goals. Thank you for watching. Do you want to know which indicator I use? Check out this video.